First, I think the most important thing happening in the world and everybody's looking at right now is inflation. What we had until now was an inflation that started because of shortage of shipping and transportation that was started in the COVID era, where much more demand for products than what the shipping was able to do, and it spiked the prices of various types of products, used cars and electronics and all these other things. The supply chain disruption was the source of inflation. Now that is much less, but what happened in the same time as that inflation was decreasing, you started to see how the inflation from other sources that are more fundamental start to come in, which of course is energy, both because of the war in Russia and Ukraine, but also because of renewed demand, and also the inflation coming from a very, very strong job market. As you'll see in the US and in other places, record amounts of employed and demand for employees. So that is also increasing inflation. This year, in terms of investments, anybody here that has a portfolio has probably experienced a down year. As you can see, it's very small, but I'll tell you that this is asset classes all around the world in local currency valuation. As you can see, nothing except energy really has increased meaningfully this year. And I'm sure most people don't have 100% energy in their portfolio. So this is a down year across all asset classes. If you own private equity, venture capital, they haven't received the memo yet, so they haven't really updated a lot of their mark-to-markets. And I think you will start to see the valuation changes in private markets a little bit later. What is driving now a lot of the problems globally is not the shortage of shipping, even though a container, that has become easier, is the energy prices. As you can see, this is natural gas prices. What has happened is the shortage of supply of natural gas, mainly because of the war in Russia, has increased the prices for Europe very much. And everybody's been talking about it's going to be a very cold winter in Europe this year because natural gas and heating is going to be very expensive. Now, as I said, the dependency of the US on, as opposed to the other countries, I'm showing here China compared to the US. The blue bars are the imports of oil that US has to do, and this is from 1999. And the orange is the oil that China has to import. As you can see, the US is importing less and less oil because it has its own natural resources. It has developed new technologies like fracking, and it doesn't depend on anybody for oil. We all remember the time where the US was dependent on Middle East oil and all these things. Today, the US is it's a game changer situation. As opposed to that, China is the other way around. China is becoming more and more dependent on oil and energy from outside. Here you can also see this is affecting China in many ways, not only the oil price, but on the left chart, it's the China Consumer Confidence Index. The current environment in China is not very optimistic. Consumer confidence is dropped very sharply. This means that demand from consumers in China and just the general atmosphere in China is not very bullish. One of the reasons for that, and I think one of the biggest bubbles that is now developing in China and in some places in Asia, is the property bubble, is the real estate bubble. You can see on the right chart, what I'm showing you is, this is the stock price of the China property companies. So since the beginning of COVID, they've fallen 60%. That's a huge number. And remember, I think what people are experiencing right now in China, especially the wealthy families, whenever they had some profits, instead of investing in other things, what they put the money, they put it in real estate. They bought apartments in new buildings, new developments. These developments are standing empty. A lot of them are not being able to either be sold or rented. They're sitting on these, they call them ghost towns. And the over-concentration of wealthy people in China in real estate is phenomenal. I would say in Korea, it's still one of the favorite asset classes to invest is real estate. And we say this for many, many years, we think you should diversify much more into financial assets. The Chinese can't do what you can do because the Chinese cannot buy U.S. companies and U.S. securities easily, while you can do that. And I think more of that should happen in Korea. Real estate is a big asset class and very important for everybody. It's one of the biggest asset classes in the world. So we have to look at what happens there. Most of the major crises in the past have started from real estate, have something to do with real estate, or become worse through the real estate. And you have to ask yourself, are we in a real estate bubble globally, right now? And how do you know that? One of the ways to know if it's a bubble is it has the momentum in the price been very strong and upward for a long time. And I think this chart makes it very easy to see. This is OECD real house prices. This means what are the house prices in all OECD countries on an average, but adjusted for inflation. So if actually this was not adjusted for inflation, it would even be higher, because inflation recently has been higher. As you can see, there has been a spike in real estate prices, especially in the last 5 years, which to me smells very much like exaggeration. And you have to be conscious that this is typically all synchronized globally because interest rates change and affect the whole global market. Now, you own maybe property, you own an apartment, you own real estate investments. How much has it went down? Everybody wants to know, is it up or is it down? It's very hard to know until you come and try and sell it or use data of recent sales in your area and where your properties are. But if one measure is to look at, is you can look at public markets, because public markets price property every day through REITs, real estate investment trusts. And this year alone, REITs are down 20% in dollar terms, 21%. If you adjust that in Korean won, it's more than 30%. So I'm not telling you your property is worth 20% less than what you thought, but this is something you have to be aware of, a trend that maybe is starting and might continue. So as interest rates go up, either in the US or Europe or Korea, debt becomes more expensive, and people that took too much debt are going to have to fire sell, and then this creates pressure across the board in selling. In Korea, hasn't been a big property bust yet, and I hope there will not be. I'm not hoping for something bad to happen, but I'm just saying diversify. Don't have everything in real estate, and be a little bit more balanced in your approach.